What's up everyone, it's Scotty with MoneyVest. So in today's video, we are going to be talking about Chipotle, ticker symbol CMG. I'll be doing a full fundamental and technical analysis on this company that is now scheduled for a 50-to-1 stock split in June, which the board of directors and the shareholders did approve. And this stock is going to go from almost $3,000 down to a very, very affordable $50 to $60 per share, depending on where it's trading prior to the close on June 6th. As always, if you enjoyed this video, find it helpful, make sure that you drop a like, and of course, don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, there's a 16% annual discount that's also available until the end of this month. You get access to our newsletters, all of our Discord channels, including trade alerts and ideas and options alerts, as well as my TradingView charts, my TradingView watch list, stock watch list, as well as our members only private videos and the moneyvest.com website that's going to be launching very soon for members only. So links going to be down below, and we'll love to have you on board. So first things first, let's talk a little bit about the stock split itself. So Chipotle stock split assessed. Chipotle announced a 50-to-1 stock split earlier this month. This is probably one of the biggest stock splits we've seen. 50-to-1 is quite insane. And the split is subject to a shareholder approval of an amendment anticipated to close by June 6th. Again, that's the date by which you need to own Chipotle if you want to take advantage of this stock split. And Chipotle's existing investors will receive 49 additional shares upon the market close of June 25th. Now, it's really important to remember these dates because seasonality-wise, April and July are the two best months for Chipotle in terms of those market gains. I'll go over that in just a minute as well. But very quickly, I want to remind everyone that stock splits basically don't do anything to the market valuation itself, because it's basically the number of shares outstanding goes up and the price per share goes down. If you multiply those two things, you still arrive at the same market cap. So the market valuation of the company does not change regardless of how you slice it, right? It's the same pie. It's the same thing. It's just different slicing and different pricing. Okay. But of course, market sees this as a bullish catalyst anyway, because, it becomes more affordable to investors and traders, and options become more accessible to a lot of investors, because right now, Chipotle trading at well over almost $3,000 obviously makes it a very, very expensive stock to the average retail investor. The moment it comes down to 50s and 60s, then automatically it's a much more affordable stock for investors, right? So reading further, first thing I want to go over is the historical stock splits for a lot of big names and how they have performed. This right here is NVIDIA. So NVIDIA essentially saw a rally of almost 91%. So that was a pretty significant gain. So this right here, basically, this is when we saw the 4-for-1 stock split back in July of 2021. And this was the entire gain of a little bit over 90% for NVIDIA after the stock split happened for this company. And again, this is not a precedent. This is not something that, just because NVIDIA rallied 90%, Chipotle is going to rally 90%. No, this is just to give you an idea how the market perceives these types of events. And NVIDIA obviously rallied for other reasons. Earnings were around the corner. Dividend was around the corner. And of course, NVIDIA being an AI beneficiary did rally significantly on the back of this stock split and other catalysts as well. But this is, of course, from 2021, so 3 years ago. This right here is Apple. Everyone's beloved stock, one of the most popular names. It actually did drop after the stock split was announced. So this right here was a sell-off. And then, of course, it rallied quite a bit. And from that stock split, it actually is still up 28, almost 29%. So just to give you an idea that not every stock actually rallies, the stock split for Apple was also 4-to-1 back in August of 2020. Again, did drop about 10 to 12% after the split and then rallied 28%. From those levels, we are still up 20% from that stock split. This right here is going to be Amazon. Amazon also did one of the biggest stock splits we've seen. Actually, this was the first stock split that Amazon's ever done, 20-for-1 stock split back in June of 2022. We did see a little bit of a decline here, so that was about a 19, almost 20% sell-off after the split, and then it actually recovered and rallied quite a bit, about 42% from a support of about $100 per share. So pulled back and then ripped higher, 40%. Same thing happened with Apple, pulled back and then ripped higher to the upside. This right here is Google. Google also went through a very similar process as Amazon, saw a 20-for-1 stock split, sold off exactly almost 9% here, and then of course pushed higher at over 17-18%. So this right here was the rally here for Google, back up to $122, and in fact it is now lower. The price is actually, no, it is back higher. So it is in the 150s. I forgot. It's in the 150s now. So it is obviously higher from that stock split. But then eventually you saw a much bigger sell-off over here, as you can see. But that was also part of the entire 2022 bear market, because this stock split happened in July of 2022. So that was in the middle of the bear market that we witnessed in 2022 as well. And then finally we come over to Tesla. Tesla also had a most recent stock split in August of 2022. And then, of course, since then, we have seen a 66% sell-off here for Tesla after a 3-for-1 stock split that happened back in August. So again, just to give you an idea, not every stock split is taken up by the market in the same way. Nvidia rallied because 2021 was also part of that bull market rally that we witnessed. Google and Tesla sold off after the stock split. Google, although, did sell off and then rallied 17-18%. Then sold off even further because both Tesla and Google were in the middle of the bear market. That's when they did their stock splits in 2022. But both Amazon and Apple pulled back and then rallied, and they are much higher than where the stock split happened for both of those companies. This right here is going to be the seasonality chart for Chipotle. So what this basically shows us is the last 10-year average gain for every month for Chipotle. And as you'll notice, April is almost at 6%. And then July is at 7.5%. So those are the two biggest months for Chipotle, where it tends to do really well in terms of that price performance. Seasonality wise, 2020 was the biggest gain of 34% in the month of April. I was not able to find anything that even matches 34% on a monthly basis. The closest we came to was around 20% in July over here. And that's pretty much it, right? So pretty big gains here in those 2 months. April is coming up, and July is going to be right after the stock split on June 25th, right? So that's when they are going to be giving the additional 49 shares upon the market close on June 25th, right at the beginning of July. July being one of the best months, actually quite literally the best month seasonality-wise for Chipotle. Now, going over to the fundamentals. Now, this is a fantastic company, as you've already seen me discuss in my previous videos. Chipotle is by far one of the best and well-managed companies in the US because of its fundamentals. You can see the revenue growth here from $4.1 billion to almost $10 billion. Gross profits gone from $1.5 billion to over $4 billion. And then we got operating income, $717 million to now almost $1.6 billion. This right here is going to be the net income. So bottom line, almost $500 million to $1.2 billion. So again, they've more than doubled their profitability. Operating income and net income and shares outstanding has really been flat from 31.5 million shares to 27.7 million. Now, this number, of course, will be going up 50 times. So they will be basically going up to almost a billion shares. So 27.7 times 50. We're looking at 1.3 billion shares outstanding as the price gets cut after the split. This right here are going to be margins. So margin wise, also Chipotle is, again, like I said, one of the best managed companies. 40% gross margins, 12.5% net income margins. We're looking at free cash flow margins of 9.4%. Then we're looking at return on common equity, capital, and assets. Also pretty strong, with net income per employee at over $10,500, which is significantly higher than the 5-year average of $6,300. So they are becoming more efficient as there is more operating leverage kicking in to the company. Now, balance sheet is troublesome, not to like an insane amount, but it does have more debt than cash on the balance sheet, which is not ideally what we like to see. So $4 billion of total debt versus just over $1.3 billion of total cash does make the company have a positive net debt at the moment of 2.7 billion. Current ratio and quick ratio are good. And then we're looking at debt to free cash flow at 5.37. So it's a little bit on the higher side when it comes to the debt levels and the debt to free cash flow. But current ratio, quick ratio are still pretty solid at over 1. So again, it's an okay balance sheet, not the best, but it's an okay balance sheet. Valuation, very, very expensive stock. I hate to break it to you, but Chipotle is one of those companies that's trading at a incredibly high valuation. We're looking at 54 times earnings multiple. PEG ratio is 2.6, which is also really high. So given its growth rate, the price to earnings is really expensive. Enterprise value to EBITDA, we're looking at around 42 to 36. Price to sales, we're looking at 7 to 8. And then we're looking at price to cash flows at just over 39 to 40. So this is a valuation that is extremely, extremely expensive here I should say. So this right here is going to be the arrow, very, very high in terms of valuation. So it's got to be super careful in terms of its pricing of the stock. Now this right here is the earnings expectation. So again, the reason why we saw a PEG ratio of over 2 is because the growth rate's only 19, maybe 20, 21%. But the P multiple is much higher at over 54, 44. So that's twice as much, more than twice as much, the growth rate in the earnings expectations. So yes, it's a very nice, consistently growing company. No doubt about it. It is a stock. It is a company that has an amazing brand. I love to go to Chipotle. I love their Mexican bowls and Mexican burritos and stuff like that. But it is an expensive stock, right? So you're really just paying for a Mexican, franchise brand that is very popular among the U.S. But at the same time, how confident are you at this pricing model? It does have a lot of potential valuation risk given how expensively it trades at the moment. So, this right here, revenue expectations from 11 billion to 30 billion. So, more than 3 times increase in the revenue expectations by the year 2033. So again, it really comes down to how comfortable you are with the stock. Now, outlook-wise, they're expecting the revenue to grow in the mid-single-digit range, and they are expecting 285 to 315 new restaurant openings, which assumes develop, permit, inspection, and utility delays do not worsen. An estimated underlying effective full tax rate between 25 and 27% for the company as well. And this is the options chain that I wanted to go over 1 month out in April. And the reason why I'm breaking this down is because to show you how accessible options will become for Chipotle once it has done the split. And this is where a lot of the volume, a lot of the demand, a lot of the institutional involvement also comes in, retail involvement comes in, not to mention that, the indexes and the ETFs will have to make that adjustments. So that is also going to create some type of demand effect. But just take a look at some of these calls 1 month out. If you're looking at, just at the money calls, they're trading at $66 or $68 per contract, right? That's one contract is going to cost you almost $7,000. Just to play Chipotle options, right? So that's a very, very expensive call. Same thing is true for puts here. So again, if you're looking at the money puts, we're looking at $5,000, $6,000 puts here. So again, very expensive options. And the reason why they do these splits is to make it more accessible to the investors, to the traders, to their employees and staff. It makes it easier for everybody. And that's why the bullish catalyst comes in. That's why it's seen as a positive bullish catalyst for the stock. Now, if you go over to the expectations here, so if you try to run the numbers on Chipotle, and let's just assume that they're going to hit a revenue number of 11.2 billion. So, let's just take in about 12% of that 11.2 billion. We're looking at, let me just do some very quick math here, 0.125. We're looking at $1.4 billion roughly. And divided by, let's say, 27.7, that's going to be an earnings per share of about $5, right? Or $50, $50 to $53, what they're assuming. So let's just go with about 1.5 billion in actual earnings, which is net income. 27.7 million shares. We're looking at $53, $54. I think that should do it. So 1.5 billion, if we apply that if we apply that net income, so 1500. Just got to change my email here. So just give me 1 second while I do that. So we can get this estimate going. So boom, here we go. Okay, so Chipotle, there we go. So if we plug in, 1.5 billion, so that's 1,500 that we're going to plug in. Growth rate, what type of growth rate are you willing to apply for Chipotle, right? Let's say 25% growth rate in earnings, which is very optimistic. I'm going to tell you right now, because if you go back to the earnings expectations, we're looking at, 19%, 21%, 21%, 21%, 18%, 17%, 15, 19, 14. So nothing comes even close to 25. I think 20 would be a lot more appropriate because we're seeing a few times it's growing more than 20, several times it's growing less than 20. So I think 20% would be a lot more reasonable. 30 times P multiple is quite appropriate for Chipotle, in my opinion. 12% discount rate, 10% margin of safety, little to no dilution. In fact, some share buybacks here. And we're looking at just under $2,200 in intrinsic value 5 years out with a price target of $4,294. And right now trading at $2,882. Only a 24% drop here needed for Chipotle to be trading at its fair value. This is going to be that sensitivity grid where you can take a look and see what growth rates and P multiples make sense for you. For me, I think 20, 30 is still a little bit on the higher side because 30 times multiple for a stock that's growing earnings by 20%, does give me a PEG ratio of 1.5. Ideally, I want to look for something that gives me a PEG ratio of 1. So, and if you go with a 25 times P multiple, then we're looking at 1800, and that means almost a 40% drop needed in order for Chipotle to be trading somewhat near close to its intrinsic value. So again, it really depends on, how aggressive or how conservative you want to be with your analyst expectations here. If I do some very quick technical analysis, we've got a very, very strong support, probably one of the strongest supports at 1220. That's going to be aligned with this right here. In the past, we've seen lots of buyers stepping in and around those prices, so that is a huge area of demand. There's going to be another area of demand for Chipotle in and around these levels, and that's going to be sitting roughly at around 1875 to 1874 to 1900. Previous resistance acting as a very strong support here from back in October 23 before rallying over 62%. And then when it comes to some reasonable support areas, I'm going to be watching this. Again, previous resistance, we struggled to break out above that level. When we finally did, this turned into a support. It's going to be 2186. So those right there are going to be some levels to keep in mind. Chipotle is very, very overbought right now on the weekly time frame, 83 RSI, very aggressively overbought at MACD. So keep a close eye at those prices. A very strong support at 2186 down to this area of demand in the $1,700 to $1,800. This is where it would be a very clear buying opportunity for me at those prices. It would be like a no-brainer buy at those prices, but of course would need a significant downside, 30 to 35% potential downside here needed from Chipotle. But right now, of course, the momentum is very strong on this anticipated stock split for this company. So hope you all enjoy this video and a complete update on this stock. Let me know your thoughts down in the comment section below and what do you think about Chipotle. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. 16% annual discount available until the end of this month, where you can access all of our Money Invest members benefits. As always, happy investing. I'll see you all in the next video.